But more importantly than simply being a tool for payments, millions of people around the world use Bitcoin as their personal savings account. In fact, there is no other asset class on earth that has outperformed Bitcoin in the long run. Welcome to part 2 of the Beginner's Guide to Investing. If you haven't watched part 1 yet, you may want to check it out as well. We'll put a link to the video in the description below. If you want to be a responsible and successful investor, it's important that you address some pre-investment considerations. These are the sorts of things that any good financial planner will discuss with their clients before investing their money. Let's discuss the 3 most important ones. Number 1. What is your current financial position? Before considering an investment strategy, you should have a clear picture of what your financial position looks like. This includes being in touch with your regular monthly budget, understanding any risks to your income and expenditure, and having a complete overview of your assets and debt situation. Why is this so important? Well, you need to know with confidence that you can sustain whatever investment strategy you choose in the long run. If you have a high degree of financial stability, this may give you the ability to be a bit more aggressive with your investment plan. Or it may enable you to invest in other, slightly riskier asset classes in the hopes of greater future returns. It's therefore crucial to take stock of your overall financial position prior to committing to an investment strategy.
The second pre-investment consideration is, how much risk are you comfortable with? Every investment decision or financial plan has an element of risk to it. But it's critical to determine how much risk you are comfortable with in general, so that you can make well-informed financial decisions. Understanding your personal risk profile is important so that you can properly align your investment strategy with your risk appetite. Not only does this allow you to sleep easy at night, but it ensures that you don't panic and make rash decisions when the market moves against you. Now, it's important to understand that risk can be managed in different ways, either by avoiding certain asset classes altogether or structuring your overall portfolio correctly. For example, let's assume you are an individual who does not feel comfortable taking on too much risk. You have 2 choices. Either you can shy away from risky investments altogether, or you can elect to still have some riskier investments, but reduce their overall weighting on your portfolio. So if you think stocks are risky, for example, you don't necessarily need to avoid them altogether, and you don't need to put 100% of your money into them either. You can structure your portfolio defensively by holding only, say, 10% of your portfolio in stocks, or 5% or 1% if that's what you're comfortable with. It doesn't need to be an either-or scenario.
Now bear in mind that as a general principle, there's a relationship between risk and reward. High risk often leads to a higher reward, and low risk to a lower reward. In light of this, you may need to balance your investment comfort levels with financial reality. In other words, there are circumstances where you may need to take slightly more risk than what you're comfortable with in order to achieve your financial goals. The best way to manage this would be to ensure your financial position is secure before investing, so that you can tolerate the effects of increased risk with your investments. Increased risk may mean that you accept greater volatility or fluctuation in your investment value. But if your day-to-day finances are rock solid and your investment goal is clear, you are likely to feel more comfortable and in control. But as a general rule, never take on a level of risk that will cause you to lose sleep at night.
The third pre-investment consideration is, what is your time horizon? In other words, for how long do you plan to invest before you need access to your funds? 1 year, 5 years, until retirement? It goes without saying that the longer your time horizon, the better your investment returns will be, generally speaking, because you allow the power of compound growth to work for you, as discussed in part 1 of this investing series. But as we all know, life is not perfect, and you may have some major milestones on the horizon, such as a wedding, the purchase of a new home, or a college education to pay for. It's essential, however, to accurately determine your time horizon before jumping into any investment, because this will affect what investment strategy you follow.
If you know that you're going to need the majority of your investment funds to pay for a family home in the next year, it would not be a wise decision to invest all your money in the stock market. Because if the market experiences a downturn, you'll be forced to sell at a loss. A year is a very short time frame when dealing with riskier, more volatile asset classes. Similarly, if you are going to be retiring shortly and you'll need to rely on the money to live, you may want to take a more conservative investment approach so you don't risk any major losses in your portfolio. But if you are younger with a 10 to 20 year time horizon and you know you can exercise discipline to not access your funds, you can much more easily afford to take a more aggressive investment strategy. Your investment time horizon is a critical piece of investing strategy, so be sure to consider this carefully before entering into any investment.
If you joined us in part 1, you know that we've discussed 6 common investment options already. But we'd like to briefly discuss 2 further asset classes which are worthy of consideration. These are precious metals, like gold or silver, and Bitcoin. Correctly understood, precious metals and Bitcoin more accurately fall into the category of money, not investments. Gold has been money for more than 5,000 years, and Bitcoin is the money of the future. But we're not going to get bogged down in the technical differences now. For the purposes of this video, we will simply refer to them as assets.
Many investors believe strongly that precious metals are an important asset to own. Gold in particular has some unique traits that has made it a reliable store of value over time, thereby contributing to a well-performing investment portfolio. One of the reasons gold has stood the test of time is due to its scarcity of supply. In other words, it is rare and its supply is somewhat limited. And this is a very important, if not the most important, characteristic for any asset to have. Gold has traditionally been an excellent hedge against inflation and a hedge against economic turmoil. This means that gold generally performs well during turbulent times. And for this reason, many consider it to be an insurance policy against irresponsible decision-making by politicians. Another attractive attribute, especially for those living outside of the US, is that gold is denominated in US dollars. And this gives those living in countries with weaker currencies the opportunity to also use gold as a hedge against the devaluation of their local currency.
So how does an investor buy gold? Well, there are 2 fundamentally different ways to buy gold. Either you buy paper gold or the physical gold itself. Paper gold is essentially a gold certificate, or said another way, a paper promise. Instead of buying the actual physical gold and holding it in your hand, you buy gold stocks on the stock market, for example. The problem with this is that you would need to trust that the company you are buying the gold from actually has the gold in their vault. There's no way for you to verify with certainty that you have purchased anything other than a promise, and promises can be broken. For this reason, serious gold investors always buy physical gold and take personal delivery of their asset. By doing this, you don't need to rely on any third parties, and you know with certainty that your asset is safe, since you actually have it in your possession.
So what about Bitcoin? Bitcoin is a revolutionary new form of money which anyone in the world can use simply by owning a cell phone and connecting to the internet. You can send money to anyone, anywhere in the world, at any time of day, completely free of limitations, restrictions, or laws imposed by banks or governments. But more importantly than simply being a tool for payments, millions of people around the world use Bitcoin as their personal savings account. Although its price does fluctuate wildly in the short to medium term, it has proven itself to be an incredible store of value in the long run. In fact, there is no other asset class on earth that has outperformed Bitcoin in the long run.
Bitcoin is probably one of the most misunderstood asset classes today, and there's a great deal of misinformation spouted on mainstream media. Bitcoin is in fact the first and only money that has ever existed that is truly scarce. And again, as mentioned with gold, scarcity is one of the most important factors a good asset can have. Bitcoin was created with the express purpose of providing humanity with a better form of money. It was invented specifically to address and solve many problems we face today, and it was designed to fulfill and improve on gold's role in the digital age. Bitcoin can be easily purchased in most parts of the world, and we'll discuss the details around this in upcoming videos. But for now, it's important to know that just like with gold, Bitcoin can be purchased in 2 fundamentally different ways: paper Bitcoin or the actual Bitcoin asset itself. Again, smart investors always want to own the underlying asset where possible, since it means that you remove third-party risk from the equation. Why involve a third party between you and your money when you don't need to? Bitcoin can be safely and easily stored in your personal custody by creating a wallet. Simply download an app like Blue Wallet or Moon, available for free on the Google Play Store or Apple App Store, and follow the on-screen instructions. We have detailed tutorials coming out on this soon.
There's an old saying on Wall Street that the market is driven by just two emotions, fear and greed. And whilst this may be oversimplified, there's a great deal of truth in it. Fear and greed are two of the most powerful human emotions. When an investment increases rapidly in price, people tend to feel a powerful sense of euphoria and greed. We all want to get rich, and none of us want to miss out on the opportunity. Similarly, when an investment decreases rapidly in price, the fear of further losses can be incredibly overwhelming. Both fear and greed cloud our rational thinking, and in both cases, if acted upon, almost always result in an investor making terrible investment decisions. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." He understood the perils of acting on emotion, and he knew that he could profit handsomely if he was able to remain calm and rational during times of extreme market volatility. Now, we don't expect you to have the emotional fortitude of one of the best investors in history, but understanding these principles may help you to avoid getting caught up in the emotional hype and making poor investment decisions as a result.
One of the most effective strategies to remove emotion from investing is called dollar cost averaging. Dollar cost averaging is a strategy where you invest the same amount of money at the same predetermined interval. For example, $50 per month. The idea is that you buy no matter the price in a fixed robotic fashion. When the market is down, you'll get more value for the same money. And when the market is up, you get a bit less value. But in the long run, you get a good average price. The beauty of dollar cost averaging is that it forces you to invest when you otherwise might not have, like when the market is crashing and most investors are too afraid to invest. And by keeping your purchases fixed, it helps you not get greedy and overinvest when the market is making a big move higher. Since most investors struggle to act against their emotions, dollar cost averaging is an incredibly useful and lucrative investing strategy in the long run. And this is why most financial planners recommend this strategy for their clients. The key is, however, to stay the course. And a good way of ensuring this is to set up a regular recurring payment, which is automatically deducted from your bank account each month and paid into your investment fund. So whether you're interested in ETFs or Bitcoin, dollar cost averaging is the way to go.
Let's now look at 5 key investment principles which every beginner should pay careful attention to. Number 1, have an emergency fund to protect your investments. It's vital for you to have an emergency fund in place before you invest, not only to help you through tough times, but also to ensure that you can stay invested in the long run. Your goal should be to protect your investments at all costs. You should never be in a position where you are forced to sell an investment to cover a bill. It'll set you back severely in the long run.
The second investment principle is to invest consistently. Saving and investing should become a way of life, a non-negotiable part of your monthly budget. Of course, this means that you'll need to get into the habit of living below your means and continue to do so even as you start to accumulate a meaningful investment portfolio. Whether it be through good times or bad, it's important that you continue investing if you really want to maximize your investment returns, even if you can only put away a little at a time. Never underestimate the enormous impact that consistent investing will have in the long run.
The third investment principle is to know what you're investing for. By clarifying your goal and the time frame involved, it'll help you to stick to your investment strategy. It's much more difficult to be disciplined in the long run if you're not clear on exactly why you are investing. Whether it be for retirement, a college education fund, or both, it's important to define your exact reasons up front. This will help you avoid the temptation to dip into your investments for short-term reasons.
The fourth investment principle is, don't try to time the market. Hollywood and social media have popularized the idea that it's easy to make tons of money by timing the market correctly. In other words, buying or selling investments at just the right time, rather than having a consistent long-term strategy. There's a reason that experts advise their clients against trying to time the market. Not only is the risk of financial loss much higher, the numbers reveal that it's not a profitable strategy in the long term. As the popular saying goes, time in the market is more important than timing the market.
The fifth investment principle is, Never invest in anything you don't understand. Before you put your hard-earned money into any investment, be sure to do some thorough research. Take the time to understand how the investment works, what the risks involved are, how you're likely to make money, and if the investment is suitable for you. Never rely only on information from one source. You should always do your own homework and take personal responsibility for your investment decisions.
We've spoken a lot about risk and how to manage it, whether it be through proper investment selection, weighting your portfolio correctly, or adjusting your time horizon. But there's one more risk to discuss, and we consider this to be probably the greatest risk of them all, and that is not doing anything. Using professional investing lingo, we may refer to this as opportunity cost. That is the lost opportunity we experience when we don't invest. If we don't prioritize investing, we incur an opportunity cost. We sacrifice the ability to build wealth because we have prioritized something else, such as more short-term spending on luxuries, for example. In today's economic climate, most of us face high levels of inflation which continually destroys our wealth and threatens our long-term financial stability. There is thus a great deal of urgency to minimize the impact of inflation on our financial well-being. And we can only do this by prioritizing investing at all costs. The opportunity cost of not investing is severe. And this is the message we'd like to leave you with. Make investing a priority. Don't wait until tomorrow. Your financial future will be determined by the decisions you make today. Thanks for watching.